All right, so chapter 5 has to do with financial statements. So we've skipped chapters 3 and 4 that have some introductory material with regards to economics and accounting. So if it's been a while since you've taken those courses or you haven't taken those courses yet, I would strongly advise you to skim those chapters as you need if you've got further questions about these financial statements. So this chapter is going to discuss the nature of financial statement reporting, its key elements, and the significance of the major financial statements. We're also going to talk about measuring things like operating cash flow and free cash flow, and how we can use common size financial statements in analyzing a firm's operations. So our learning objective here, we want to outline the purpose and importance of the income statement. So the purpose of the income statement is to determine a firm's profitability for a specified period of time. What we mean by profitability is revenues, or the amount of money we're bringing in, and the expenses, the cash that's leaving our hand in terms of things we're having to pay for. So it's revenues less expenses. In instances when revenues are greater than the expenses, a firm has net income and is profitable. And when the expenses are greater than the revenues, the firm has a net loss and is unprofitable. Note that, there are entities like nonprofits where their success is measured by meeting objectives in a way that is different than profit, but a nonprofit, as we like to say here at Union University, because we are a nonprofit, our current president Dove likes to say we're not for profit, but we're also not for loss. So we have to balance the budget, so to speak, every year. So a classified income statement, if you look at one of those, it's going to subtract expenses in the following order. So you're going to have sales, and then underneath your sales, you'll have cost of goods sold that's deducted, and that gives you gross profit. Then underneath gross profit, you'll have operating expenses, and those operating expenses are deducted from the gross profit. That's going to give you operating profit. And then from operating profit, you'll have interest expenses on instruments like debt, loans, et cetera. You have to pay interest periodically. So those expenses are deducted from the operating profit, and it gives you pre-tax profit. And then the last thing, once we have our pre-tax profit, we have to pay the government income tax. So that's income tax expenses. We deduct that from our pre-tax profit, and that gives you the final result, which is net income. Okay, so it goes gross profit, operating profit, pre-tax profit, net income. And the order of that is sales minus cost of goods sold, minus operating expenses, minus interest expenses, minus income tax expenses. And that'll get you your net income. So that's how we start off with revenue at the top of the income statement, and at the very bottom, wind up with net income. A couple other final notes here. If you're not profitable in the long run, you're not sustainable, and you will go out of business. So therefore, a firm's purpose then is to generate a profit from operations. And then everything I just stated here is in that order there on this slide. So that's your key structure and elements of the income statement. A couple other things here. EBITDA, that's going to be earnings for interest, taxes, depreciation, amortization. It is a proxy for cash from operations. Now, EBIT is also sometimes known as operating income, okay? And it tells you the amount of earnings that a company is generating from its operations. Note here that your interest expense is not deducted from EBIT because the amount of interest a company pays on its debt is a reflection of how much debt it has. And the decision to borrow or not borrow money, that is a financing decision. It is not an operating decision. So for this reason, taxes, depreciation, and amortization are added back to EBIT, because taxes are not factored in because a firm's income tax expense is not a function of its operational efficiency. Taxes are just a function of the government charging you for, using their infrastructure, military, et cetera. Those, intrinsic benefits we get from those things. And then depreciation and amortization expenses are also there for tax purposes. They're accounting expenses. Cash actually doesn't change hands, so therefore we add them back. All right, so a balance sheet reflects a company's financial health as of a point in time. It's composed of assets equals liabilities plus owner's equity. Assets are on the left side, and they're the resources available to the firm that helps you generate revenues, profit, and cash flows. The right side is composed of two different elements, the liabilities and owner's equity. and it tells us how the resources were funded. So liabilities are going to be funds owed to suppliers, banks, employees, and other creditors. Owner's equity is the residual interest or assets minus liabilities piece. And this comes from funding that's provided by contributed capital, which means it's obtained from owners or stockholders, or earned capital, where we retain earnings, we keep money that we've already made and we just use it for the next period, or it's not distributed by the company. So note that the balance sheet reflects the company's position at a certain period or moment in time, whereas the income statement is going to summarize a firm's activities over a period of time. Okay. Note that the left side of the balance sheet is going to show the assets in order of liquidity, meaning how quickly we can turn something into cash. Because the cash balances of a firm are already in cash, cash is necessarily then listed as the first asset on the balance sheet. Okay, so moving to this slide here. So assets are broken down into either current assets or non-current assets. The cutoff between current and non-current is normally a year. If a firm can convert an asset into cash within a year, it's a current asset. If a firm can only convert that asset into cash in longer than a year, that asset is a non-current asset. Okay. The right side of the balance sheet is composed of two sections, liabilities and owner's equity, and is ranked in terms of preference and liquidation. Liabilities are going to be positioned over owner's equity. This just means that if a company goes into liquidation, in other words, they have to go to court for bankruptcy proceedings, the creditors represented by the liabilities will be paid first, and if there's any money left over, owners receive anything. Okay, so this is why equity ownership is very risky, because if the company goes broke, you're probably going to lose all of your investment. Okay. So the riskiness for creditors is not as much as it is for owners. Note again that liabilities are also split between current liabilities and non-current liabilities, just as we described for assets. So now identifying, the balance sheet and the income statement, those pieces together. So there are several connections between an income statement and balance sheet, but the most critical link is retained earnings. Retained earnings belongs to the owner's equity section of a balance sheet and represents earned capital. This is in contrast to the other major portion of the owner's equity section known as contributed capital. So as a company generates net profits over its lifetime, those profits flow from the income statement into the retained earnings account. Now, some companies will make distributions to shareholders in the form of dividends, and these distributions are taken from retained earnings. So dividend, it just means if you own a share of stock in a company, you receive a monetary benefit, typically a cash flow, or the amount just goes into your account per share that you own. So anything that's not distributed is kept or retained, and that's why we call it retained earnings, earnings that were kept and not distributed. Another note here is that expenses are subject to something called the matching principle. This means that they're incurred in a given period to generate the revenues for that period. Now, sometimes expenses are going to be paid in the same period that they're incurred. In these cases, there's no difference between what was incurred and an expense that was paid in cash. In other instances, the expense is incurred in one period but is paid for in a subsequent period. One common example of this is that your employees are going to work, and then after they work, you then provide them the paycheck, so it's a little bit deferred. So that lag between expense recognition and cash payment results in a payable. So one common example of something you could see is like a wages payable. The other one that's most common are accounts payable, where you're deferring payment to your suppliers. So now turning to section 5.4, owner's equity represents the investment of the owners in the company. Owner's equity sits at the bottom right side of a balance sheet and means it has the least preference in liquidation. Owner's equity is the source of capital for a firm that is most at risk. If a liquidation occurs, owners sometimes don't receive anything for their investment. If a company fails, the owners can lose everything. However, if a company does really well, the owner's equity stands a chance of being able to generate the highest return possible on their investment. So high risk, high return. Risk and reward go hand in hand. To generate the highest possible return on investment, one has to be willing to accept a higher level of risk. The statement of owner's equity shows how the owner's equity accounts have evolved over the year, and this includes several activities. So you have new sources of funding that would be contributed capital. These are new investments made by owners, sales of new stock issues, or reissues of treasury stock. And earned capital, these are additions to the retained earnings account via net income earned that year. We also have new uses of funding. So from a contributed capital perspective, this could be repurchases of owner stock, otherwise known as treasury stock. And then earned capital, these are distributions from retained earnings in the form of dividends. So there's what I've said there on that slide. A couple other notes here just to recall: owner's equity, it's contributed capital or earned capital. Contributed capital funding provided directly from the owners. Earned capital funding generated by the business and retained otherwise and not distributed. The most common form of distribution to owners is dividends. Retained earnings refers to the fact that earnings are kept, not distributed out. All right. So now turning to section 5.5, the statement of cash flows. So what is its purpose and why is it important? Well, because income statements are created under accrual accounting rules that don't reflect cash inflows and outflows, we have to have this separate statement so we can understand the changes in the cash flows over the year or period. The cash flow statement is important because firms don't fail because they don't generate profits. They fail because they don't have cash to pay their bills. Okay. The first place where trouble at a company shows up is not in its income statement, but in its cash flow statement. The first line of a statement of cash flows is the starting cash balance for the year, whereas the very last line of the statement is the ending cash balance. So we're trying to reconcile what happened with cash and how it moved throughout the company over that period of time. So it's asking, the statement of cash flows is asking the question, explain how the beginning cash balance became the ending cash balance by showing where cash flowed in and out, where cash flowed out. We can break the statement of cash flows down into three parts: cash from operations, cash from investing, and cash from financing. So cash from operations, this is net income plus non-cash accounting charges plus or minus changes in working capital. So non-cash accounting charges would be things like depreciation, amortization. Working capital, that's the different, net working capital is the difference between your current assets and current liabilities. So we're looking to see how those accounts have shifted and changed for the day-to-day operations of the company over the current period in time. Cash for investing activities is a little bit more of a long play. These are net increases or decreases in fixed assets or investments. And cash from financing activities are funding obtained from or repaid to debt holders or equity holders. Generally speaking, if we're just doing a quick glance at our statement of cash flows, we want to see positive cash from operations, negative cash from investing activities, and it's kind of a mixed bag in terms of cash from financing activities. Okay, it could be negative or positive. It's going to depend on what the company's doing with regards to their capital structure, meaning their debt to equity mix, how much is in liabilities, how much is going towards or focused on owner's equity. And it will depend also on where the business is in the life cycle of a business. If it's slowly but surely growing, it's probably going to be issuing out a lot of debt and stock, so that financing cash flow will be positive. If it's a more mature company that's paying dividends and paying off debt, the financing cash flow will probably be negative. So there's your definition there for operating cash flow. So it's operating income, otherwise known as EBIT, earnings before interest and taxes. We multiply that by 1 minus the tax rate, whatever that is. Currently in the U.S., the flat tax rate's 21%, but most companies don't even pay 21%. But if you were just to use the current legal standard 21% as a quick proxy, plugging that number into our equation there will give us something called NOPAT, and that is net operating profit after tax. Okay. So operating cash flow is going to be equal to operating income plus depreciation minus taxes plus change in working capital. Or as you see here on the screen, another way to say that would be NOPAT plus your non-cash accounting charges, which again, that's depreciation, amortization, plus or minus changes in working capital. So looking at how current assets and current liabilities shifted over time. And that all that work together will give us operating cash flow. Free cash flow is operating cash flow minus capital expenditures. So looking at what investments we're making. So an example of a capital expenditure would be building a new building, okay, or installing or building a machine, okay. So free cash flow is cash that is free for distribution to debt or equity holders. That's the amount of cash that a firm would generate independent of how it's financed. If you generate positive free cash flow, you're self-financing and you don't need funding from outside sources. So this is kind of the ultimate goal. You want positive free cash flow. And the reason why you want this is because you can do whatever you want with it. You can make new investments, repay debt, pay dividends, or buy back stock. Firms that generate negative free cash flow, otherwise known as FCF, have to take on new debt, issue new stock, cut dividends, or cut their capital spending programs. And these are less pleasant decisions to make compared to the decisions available when free cash flow is positive. So again, recall we said that firms don't fail because they're not profitable. They fail because they don't have enough cash to pay their bills. And this is true especially with nonprofits. So if a company doesn't pay its bills like gas, phone, if it doesn't pay its suppliers nor its employees, what's going to happen? Well, the gas company is going to shut off the gas line. The phone company is going to disconnect their service. Suppliers will stop making deliveries until they're paid or, renegotiate their contracts. And then if you don't pay your employees, they're just going to quit and find a job elsewhere, right? So that's, assuming that obviously job market's good and they have skills where they could deploy them elsewhere, et cetera, et cetera. But regardless, you don't want to get in that situation. So cash management is absolutely critical. So there's a lot of push-pull in terms of what you can do with your cash management, specifically with working capital that's composed of those current assets and current liabilities. More specifically, two examples of current assets will be accounts receivable, that's your credit sales, and inventory. And then two examples, if you will, for your current liabilities would be like your accounts payable and wages payable, okay? So it's important that you try to accurately forecast the cash coming in, the inflows, versus the cash going out, those outflows, because that's going to help ensure that you never have a deficiency with your cash flow funding. That's the ultimate goal. So now moving towards common size statements. So common size financial statements, we use these when analyzing financial statements, and this allows for comparisons between firms of different sizes, and it allows us to see how the income statement has changed and how the balance sheet has changed with regards to their components over time. We could try to evaluate using all absolute dollars, but that's a lot more difficult to do because it doesn't give us perspective. We don't see what's been happening over time. We also can't compare it to other similar sized or other firms in the industry. So how we do this is we take everything in the income statement and we divide it by total sales and look at those percentages and how they've changed over time. With the balance sheet, we can change those into total assets, or because they're equivalent, assets equals liabilities plus owner's equity, we could also convert it into that function. But that kind of gives us a sense of how much each account percentage-wise is being based off that total assets number. So why do we do this? Well, this can basically reveal to us how has the company evolved over time with regards to its profitability as well as its structure regarding assets, liabilities, and equity. Note that financial analysis is like being a detective, okay? So there's a lot of questions that can come about. What can you do to bring your gross profit levels back to where they were 2 years ago? Suppose you have new trade terms for your customers. You're trying to bring more of them in, but it looks like that they come with higher bad debt expenses. So in other words, they buy from you, but they buy with credit, and then they wind up not paying you back. So you lose money, you lose cash. So should you revert to your old trade terms? Maybe your selling expenses have grown over the past 3 years, and this growth has caused your margins to deteriorate. In other words, you're not making as much money. Is there something you can do to reverse the trend? So this line of questioning one can pursue is limited only by your imagination and your creativity, as well as the availability of your data. So typically when we compare our common size financial statements, we're going to do this with a peer group or peer, and that can help us reveal differences in operational efficiency where we're looking at analyzing the income statement and balance sheet. So some examples of questioning could be, what does my competitor do that gives them a 2 percentage point advantage in cost of goods sold? My main competitors are employing more debt. Should I take on more debt? The best performers in my industry, again, your peers who you're trying to aspire to be, they have net income margins of 10%. What can I do to try to catch up with them or maybe even surpass them? Okay. So the last section here is talking about reporting financial activity. So financial statements can be generated for any period of time, but are most commonly generated for months, quarters, and years. Okay. So 12 months in a year, quarters, 4 quarters in a year, or just yearly. Okay. So at most 17 times, but probably a mix of those. Typically, your public companies are going to publish reports in 10Ks and 10Qs. 10Ks are annual, 10Qs are quarterly, respectively. So typically at least 5 times a year, but at most 17. Accrual accounting requires that clear cutoffs are established, and the internal reporting will follow a different calendar depending on management's need for financial information. So there's going to be external statements that are required by investors, government, and then you've got internal working documents like your budgets that only the managers see to help them make their decisions. Okay. So firms have to choose between two options. Calendar years are going to start either on January 1 and end on December 31st. Okay, that's set. But your fiscal years can start and end on other dates based on the firm's based on its business cycle. So, for example, a lot of higher ed institutions will end June 30th. A lot of government agencies and the government itself are going to end September 30th. Some companies just stick to the calendar year. Okay, so it's going to vary. I've seen companies literally start and stop every month of the year. So you just have to find out what that looks like for your company that you're interested in or the company you work for. So some more examples. Retailers, for example, tend to have very busy Decembers, followed by a lull in activity in January when everybody bringing stuff back. Hopefully they're not, but that does happen, right? You have holiday sales and clearance events. So a lot of them have decided that they're going to end their fiscal year January 31 or February 1 because they're not going to be in the black, so to speak, until Black Friday, meaning they're not going to actually start making money until the end of November, right? So you want that last quarter of business, those last 3 months in November, December, and January to really capture what's going on. Because otherwise, if you don't, then your financial statements are going to look really, really bad, and that's going to hurt potential future investment. It could be, making decisions before you really need to make decisions because the most of your business is happening those last 3 months. So looking at, timing, the time period used in preparation of financial statements must be clearly stated and the financial information must reach its users in a timely manner. Otherwise, decision-making based on the information is delayed. Now, in terms of what the SEC requires, Securities and Exchange Commission, public companies must abide by GAAP, the generally accepted accounting principles in the United States, as well as the requirements of the SEC. They require 10Qs and 10Ks, as I previously mentioned, and public company financial reports have to be audited by CPAs or certified public accountants, and reports on those internal control processes are also required. So note, you can find out more information about a company you're interested in or that you work for. Those financial statements typically are on the investor relations website of the company, but they're also required to submit to the SEC website at www.sec.gov. And you can also, more specifically, the database that's used for that is EDGAR, EDGAR. So if you Google search SEC EDGAR, you can quickly find that, and that has just terabytes and terabytes of information. They get 3,000 submissions daily, business days. So all that information is housed there. So thanks for listening to this presentation and hope to see you in the next one.